Welcome to the next episode of Chartered Accountant's Pen. Today, we'll understand the accounting treatment and journal entries for lessees and lessors under IFRS 16. Under IFRS 16, lessees must recognize a right-of-use asset and a lease liability for almost all lease contracts. At the commencement date, the lessee recognizes a right-of-use asset and a lease liability, both equal to the present value of lease payments. Each year, the lessee records interest on the lease liability and reduces it. The right-of-use asset is depreciated over the lease term. Lessors classify leases as either finance or operating leases, based on whether substantially all risks and rewards are transferred. In a finance lease, the lessor recognizes the asset and records a lease receivable equal to the net investment in the lease. Each year, the lessor records interest income and reduces the lease receivable as cash is received. For operating leases, the lessor retains the asset and recognizes rental income over the lease term. To summarize, IFRS 16 brings most leases on the lessee's balance sheet and changes how both parties recognize and measure lease-related transactions. IFRS 16 requires both lessees and lessors to disclose enough information to help users of financial statements understand the impact of leases on financial position, performance, and cash flows. General disclosures for lessees include depreciation charges for right-of-use assets, interest expense on lease liabilities, total lease-related cash outflows, new right-of-use assets added during the year, maturity analysis of lease liabilities, and expenses related to short-term or low-value leases. In our example, the right-of-use asset is valued at $43,295. Depreciation per year is $8,659. Interest expense in year one is $2,165. The lease liability reduced by $7,835, bringing the closing balance to $35,460. Finance lessors must disclose any profit or loss on sale, interest income from a lease, maturity analysis of lease receivables, and risk management practices for residual interests. In our example, interest income in the first year is $2,500. The lease receivable starts at $50,000, with $7,500 received as principal. This leaves a closing balance of $42,500. Remaining lease inflows are expected over the term of the lease. For operating leases, lessors must disclose lease income recognized during the period, future lease payments under non-cancelable leases, and descriptions of leasing arrangements. In our example, the rental income for the first year is $10,000. The equipment is leased out for 5 years. Total expected income over the lease term is $50,000. Thanks for watching. For more accounting concepts, don't forget to like, share, and subscribe to Chartered Accountant's Pen.